Hello, everyone. Welcome back. I am not in Tampa today. I am in New York City with Mrs. Parker having breakfast and looking out at the city. We got a lot of rain last night, and I think it's going to be a nice day today. So, fun time in New York City, nice weekend hopefully coming up here, and glad to be back with the trend following trading crew. Wanted to make a couple, obviously, raise your hand if you want to be moved up on the stage so you can speak, and I'll get you up here. And I'll move you off if the connection is bad, or if you forget to mute and it's too much noise or whatever. So, but come right back. Raise your hand again. Get your connection straight, and then we'll be back in business. Today, because I'm traveling, I'm going to have to sign off in about an hour and a quarter. So, of course, someone else can take over and keep going. But anyways, it's been a crazy week with the stock market, and I enjoyed Derek's article, and I enjoyed the talking about EQR, I guess, a bit. So hopefully we got a lot of things to talk about. So please don't hesitate, don't be shy. Good morning, Oleg.
Hi to everyone. As always, I want to say that I'm very happy to be here. All this week, I was thinking about the strategy, about the multiply exit strategies and strategy diversification. And so I understood that I had to remember all my research, and I understood that probably it will be more good, more perfect to have each exit rule for each strategy. So I was thinking a lot about this.
It's good to see Niels. Hi, Niels. I really enjoyed the podcast with Mark, and especially the few paragraphs I tweeted about the old US CTAs and speaking the correct language. So I thought that was very interesting, and I listened to it more than once, I think. But I always go back to my tried and trusted YouTube, uh, so I can look at the transcript and scrutinize every single little word.
Hey, Jerry, thanks very much. I'm just on a call, so I'm just going to mute myself for a little while and I'll rejoin the group later.
I also want to comment on the last podcast by Niels. I think actually, not only have you been very kind by answering all the questions that I've been posting on the last few podcasts, but I think that this type of communication and kind of understanding as well from the new perspective was really interesting, and the ideas behind the sales and client management process was really insightful to me. So
it was a very interesting podcast with Mark and Niels. Look, one of the questions that came up was that there was a suggestion that as trend followers or as classic trend followers, there's a need for us to change the way we discuss our method with more traditional traders. My concern with that is that the lexicon that's used in that conventional speak is just so inappropriate for our method that I actually don't see that there is a way that we can achieve that, because we can't talk in terms of Sharpe ratio, we can't talk in terms of single point statistics, we can't talk in terms of standard deviation. All of those concepts basically go against our entire philosophy. So I'd be interested to hear how we can address that. And I'm at a bit of a loss really to work out the way we should be pitching our conversation to, for instance, attract allocation in the markets, etc. If, for instance, it goes against the grain of our entire philosophy.
Yeah, I agree. I think you have to pretend and not be who you are. And then over the years, in the 90s and 2000s, even when I was successful at raising assets, it was strictly from managed futures people, managed futures industry. I remember our largest client, I went to them and I said, "Can I trade cash equities?" And they said, "No, you're a futures trader." And then I went they were super sophisticated, but we were dealing with the managed futures department, you know. And so then a few years later, I went to them and said, "Can I trade single stock futures?" And they said, "Sure, you're a futures trader." So it really can get very frustrating. And over the years, we would come to the conclusion that we should have never been transparent about who we really were. We should not have called ourselves CTAs. We should have made up fancier words about to replace trend following. And so you really do get pigeonholed, and you hear about managers with diversification making money on trends, global macro is maybe what they call themselves, and we're sitting here in our little tiny little niche, not able to um, be looked at in the same way that people who are less transparent, less diversified, but still probably following trends and trading currencies and some commodities. So it really became a very obvious over the years we'd made a huge mistake by being way too honest about exactly what we were doing. And the one thing, I don't know if it came up, and I can't remember exactly if they got into this on the podcast, the idea that they are speaking a different, the language. The person across the table agrees with the CTA who vol targets and who thinks that locking down that portfolio, not letting profits run, but really adding more risk management control on the portfolio. Not only they speak in that same language, but they agree with each other, and they're not faking it. And so they really don't like the trend following. Neither group does. The allocator and the CTA, they are perfectly happy with this love fest that is a little bit of trend, just enough trend, but we can do so much better. And we all agree that these additions to classic trend following need to be uh, inputted because everyone realizes that sharp is our ultimate goal.
Hey guys, Avi here. Thanks again, Jerry, for leading this. I think it's an interesting topic, and one that's timely for me. I was having a conversation this week with a friend who was a partner at a large multi-billion-dollar long-short equity fund, and I hadn't spoke with him in a while. And I just gave him an update on what I was looking at, what I was working on, and this just trend following methodology that I'm applying to equities. And it was just so surprising that that was part of their process. Actually, that was part of their top of the funnel process where they're looking, they have their universe of names that they're looking at, and they use a trend following approach to screen top of the funnel and identify names to then start doing more work on, from a fundamental, more, let's call it value-based or traditional diligence, business diligence type work. And so it was really surprising, exciting, comforting to hear that, because that's basically what I've been seeing since I've been working on this, is that there is an opportunity to catch these trends. And he actually connected me with there's other people on the street that look at equities in this way, and I hadn't been really exposed to them, but then I'm starting to hear their names and look at what they're doing. So it's out there. It's just maybe, as you said, Jerry, it's not described and couched as the way that trend following CTAs are doing it. It's the language is a little bit different. So I definitely can understand that.
I want to take the devil's advocate, as I always do. We, as fund managers, portfolio managers, asset allocators, however you want to put it, are delivering our product, and that product is going to fit into whatever that client already has. And I think that the whole industry of funds and managed futures, global macro, however, everyone's gotten a lot more sophisticated and gotten a lot more targeted. What specifically they need, they're coming out for a need, we're providing that need. And I believe that the language is still good. I believe that understanding factors, understanding Sharpe ratio, understanding what metrics that the client is using, and what gaps or holes that you're filling in their portfolio is extremely important, because as with any service, which is what we are providing, we need to know the needs of the client. The language that you use to communicate with the person across the table, if you're speaking the same language, it's better. You can imagine if you're doing some business cross borders and you need an interpreter, that's worse than being able to talk directly and say English, for example. And now, I mean, I think to Avi's point, we do see, at least in my experience, you do see some people who are also able to replicate similar strategies, and there might not be a lot of added value um, to them because they have been able to bring this type of thing in house, or they have something that's like 80% similar, and I'm paying you your full management fee for that 20% differential. That may not be worth it in their risk reward metric. So I think that targetedness and the sophistication and how much literature and podcasts and there are about this type of thing maybe gives them slightly overconfidence that they're able to do it themselves, or maybe they actually do have hands-on experience in a team inside that just doesn't need it.
Yeah, that's a good point. I think to some degree the the description of a different language implies, that they don't understand way more. But the fact is, I think they just disagree. It's like if you put the Republicans and Democrats into the same room to discuss a controversial issue, they're speaking a different language, but they definitely understand each other. They understand each other perfectly. They don't like each other. And this language is really a cultural, deeply held beliefs and I think that's sort of another element that even if you can hire me, and this is the key, hire us, bury us inside of your multi-advisor portfolio. I'm doing something different. Everyone else is doing something similar. You kind of agree with this other thing too that's less than classic. No, it just seems like it's a very difficult to do that. And I've talked about this sovereign wealth fund that was the entire CTA industry back in the 2000s. I mean, they were basically, everyone had $1 billion from these people. So that's an overstatement, but it's kind of close. And they were the greatest clients ever. And then when they shut it down, they, just like Derek said, they shut it down. And the explanation was, we'll just bring it in house. Tell us why. What are you doing that's so special? So they kind of turned on all of us. And yet the CTAs that had more of the PhD background and the quant background, I think a lot of those guys were spared and did not. So there definitely seems to be a big edge if you can combine the two. Maybe not talk the language or believe what they say. You can probably talk about outliers and trends as long as they feel really comfortable about the person that they're talking to in the schools. And as Mark said, the MBA program and what they're teaching in those schools. And it's hard to probably for those guys to turn their back on that stuff and say, oh, that's not really that important anymore. I'll have some classic trend followers as well. I don't see any evidence of, even at 50 basis points, at one point in time, I think it was GSA in Europe that everyone was at 2 and 20 or 1 and 20. And then all of a sudden they said, okay, here's trend following for 50 basis points. That threw the industry for a loop as well.
Jerry, I think I can't relate to the fund managers, but I think utilizing your Republican Democrat analogy underscores the fact that we need to make sure that we don't style drift and that we stay true to our principles, because I think every single one of those folks, or at least back in the day, went there to govern, not to politic. And I think there's been style drift from governing. The days of Reagan and Tip O'Neill coming together for good for the country, regardless of politics. And they've style drifted from governing and moving forward to short-term myopic, give your base what they want to hear politics. So I think we can look at that as a cautionary tale that will be dysfunctional if we style drift.
That's a good point, Brian. If we start speaking this same language as them, we are inevitably going to style drift, because all of our discussions, we can't use the word outlier because they're regarded as anomalies. And the way these people treat anomalies is they exclude them from the data because they're exceptional, non-predictable events that are regarded as anomalous features. So they extract them from the market. If we talk about Sharpe ratio, we're already crucifying ourselves because our method basically guarantees a lower Sharpe ratio. So as soon as we start speaking the same language as them, we're compromising our basic philosophy. And I honestly think that the classic trend followers need to stay true and consistent to the philosophy and their language as well, because it's so exceptionally important. And this is where I've got an issue, for instance, with AQR, where they tell people that they're trend followers, and we find out ultimately, well, actually, they're probably not trend followers if Artiset was right and they're using cross-sectional momentum methods as opposed to trend following, but they're sort of pitching themselves in this category. This is this confusion that language brings. And I think that we need clarity in what our classic trend following does. And we also probably need a bit more sort of togetherness as classic trend followers in the way we market ourselves. And that's something I think is lacking, because I don't actually see this collective, effort made by, the classic trend followers to get together and really sort of clearly enunciate exactly what that philosophy is, so that everyone is aware of what they do and how they do it.
So here's the question: is it really that impossible to bridge the gap, so to speak, and accept the fact that this strategy is not going to be a too sharp, but it's not going to be a too sharp for a reason, because it's positively skewed and therefore has some properties that may counteract some of those other strategies, and therefore a fully diversified portfolio that really strives for maximization of long-term wealth could benefit from it. And in other words, instead of sort of becoming the industry pariah, trying to integrate with some of the other strategies and to coexist. Is that much of a pipe dream, of an utopia, or could it be done? Because I agree that it's not a problem of changing the marketing mumbo jumbo. Everybody could go out and talk about Sharpe ratios and adopt the jargon, which it's quite easy to do, but the strategy is going to work in a different framework that might actually add value to a product.
Bruno, I think that you hit the nail on the head. If you think of yourself as a puzzle piece, okay, I'm not the most successful raiser around, but I believe that I am a product manager. That's what a portfolio manager is. You've created a product that people want or need, and you understand that you're going to be a part of a mosaic, and they are going to have negatively skewed strategies. I don't think that you can adopt their language if we have second level thinking. If we understand what the client wants, how you fit in, you individually may not have a high Sharpe ratio. However, if you add it to a portfolio of negatively skewed strategies, or things that, like if you add a CTA to a 60-40 portfolio, you massively increase the portfolio's overall Sharpe. So you're a team player. This is how I've been going about marketing. Okay, I don't know if I could say that, we're recording and all that, but like, this is the type of strategy that I like to approach, because you can maintain your core beliefs of what you're delivering, and you can also deliver And if you can get them to understand that you're a team player, that what the alternatives sleeve that you fit in and how you can augment what they're already doing, they need those carry strategies, because if you're a sovereign wealth fund or you're a pension, you need to be hitting that return target every year. They cannot miss, because otherwise it's extremely detrimental to the people. So there's a reason that they're doing that. They're not stupid. I don't want to put it in a different way, but you can improve their journey through their returns as a team player. And I think that that's been.
Yeah, I mean, in some respects, when I refused to evolve, just stood still, and I was becoming more unique. But it didn't always seem to help, because yes, they were interested in adding CTAs to their portfolio, but how about adding, someone different, but kind of not that different, because I'm just sticking to what I've always done, to the group of CTAs. And I found that to be another question, another little hurdle. It wasn't so much, will I add CTAs? Of course, but will you add Classic in with your CTAs? That was a little bit more difficult. What are you offering? We sort of agree that we don't like these big drawdowns. We don't like what happens when you play for these outliers. They make a lot of money, but then the drawdown is large. So we prefer this way of normalizing and minimizing the returns to keep things more sane. So that, I think, that I found that to be difficult to pitch that. I do think the ultimate idea, though, is to just do what we're going to do and then not really stress about it too much, and just we're not going to give in and do things we think are incorrect. And then it's definitely possible that we're in the midst of a period where we'll be extremely rewarded for this. We're kind of, I think, seeing it to some degree already. The more Classic is doing better when there's better trends. I mean, duh, that's no surprise. So if we're patient and just say, hey, it may take a while, but at some point in time, people are greedy and they're going to say, okay, I now see in real life what I missed out on by not having some money allocated to a Classic style. Then just be there and be ready, and get the fruits that you deserve, because you never changed. And I think the problem with that is that we want to do something that looks like we're making progress towards getting more AUM, but I think sometimes you just have to wait for the people to wake up and agree, oh yeah, you were telling me something that I should have listened to for a long time.
One of the main reasons why I love transform philosophy is that this philosophy is a philosophy of successful people in general, and we can apply it to many fields of our life. And as we know by statistics, that only maybe 10% of the people are really successful in the world, and it's not comfort. In all fields in general, in business, in science, maybe, and in any field, of course, it's not. It's uncomfortable for most people, and I love transforming for that. I love transforming that. I understand that I pay the price and I get a result. I'm rewarded for this. I love this in this sport.
One of the problems we face as trend followers is that our solution itself is an all-weather solution, and the way I see it is it basically delivers these very powerful long-term returns over the long term, which I think every portfolio manager wants to achieve. But as soon as we get into the allocation issue, that's where we come undone, because our solution itself is basically 100% trend following, nothing else. We don't need any other strategy. We could embed some negative skew in there if we wanted to flatten our curve, but that's just going to compromise our net wealth in the long term. So as a comprehensive solution, it speaks for itself, whereas all of these other methods tend to be sort of targeted for a particular return profile. You've got different methods mean reversion methods, negative skew, all of these different things are targeting a particular return profile to basically put themselves into a position where they can actually act as a sort of an ensemble in a portfolio by an allocation method, 10% of this, 20% of this, 40% of this, or whatever. But our solution itself, it's really 100% self-consistent. So that's one of our problems. Maybe we should be less concerned with attracting allocations and more concerned with just delivering long-term, returns. And just it is what it is.
Unfortunately, I can't do that. I can't not try to attract new AUM. I don't have a big enough base. I'm still trying to build up a business, and to do is what it is tough. It's really hard.
But do you
Try.
compromise your return profile through that philosophical basis?
Explain what you mean by.
Well, is it selling yourself to the devil? That's what I'm saying, in that because you need to attract additional allocations, you're prepared to compromise your positive skew, all of these different factors that are sort of are tied to our classic trend following approach, and therefore actually compromising your long-term wealth story at the end on the basis that you're delivering smoother returns for your client.
But really, is it? Because maybe I'm speaking about my own research. I've spent some time trying to do that and trying to see if there was a way of preserving positive skew and allowing for a bit more, a bit more standard or a bit more generalist approach to follow trends. Obviously, my answer, and we talked about last week, and we had enough of a debate, and I don't want to go back into that. But my answer is that using continuous signals, having a bit of not at the very micro level, but at the macro overlay level, some vol targeting, vol control helps. And in a way, I'm really trying to kind of bridge the gap as much as possible into traditional. A more traditional way of portfolio managing, because I do believe that the strategy has some qualities which are very much needed in a long-term wealth sort of portfolio. As you said, Richard, all weather, and Ray Dalio, not that I am in any way as capable or as credible as he is, but he built a wonderful business out of it. So it can be done, it could be done. Obviously, I don't think it's possible to keep the framework as rigid as it is and sort of walk over to the other side. But is it really selling your soul to the devil trying to do that? Because if it is, then I have a nice place in hell waiting for me, and it's a better.
Don't make me laugh, Bruno.
Yeah, no, and I'm just kind of following up on what Derek said is. I totally appreciate that the purest trend following will have the best outcome in the long run, but if you can't raise money off the strategy because you're up 20% one month and then the next month you're down 5%, and how do you pitch that to people, and have any way to explain it, then you don't have clients, you don't have a business, so you're not even in the game to see what happens 20 years from now. So I totally appreciate that the purest strategy will give you the best results in the long term, but I just wonder the practicalities of it, and what people are looking for their returns. Like, is that really something that's feasible?
I mean, I want to touch on this. Maybe you should call me a neo trend follower. I don't break any golden rules, as in I have a positively skewed return distribution. I have a lower hit rate than 50%. I use trailing stops. I trade all of the markets, and I'm exposed to both continuous and the classic kind of signals. So that goes to Bruno's question. Yes, I do use those types of things. But I think we should get away from the religious aspect of it. We're here to discuss this idea that we have. And yes, there are new approaches. I do believe that there is staying power with what Jerry has done. Obviously, he is the most pinnacle example of that. But the world now, it still will do it. It's slightly different. But because of what we were mentioning earlier, that these people have brought some of this stuff in-house, that there is things that you need to make unique because you are selling a service as well as a product that is delivering something to the client, that is not something that can be ignored. And if you are trying to build this up in a professional standpoint, you have a business to run, you have costs, you have people, you have and anything and everything that comes with trying to deliver a good product behind. So I think for me, and when I first joined this, I'm kind of going through that self-reflection period where I was asking, Jerry, what to do, and you as well, Richard, and asking all those questions to Niels that was answered on the podcast. I think it's really hard to evaluate how do you bring this in, how do you do that as someone who's just starting out. And I have decided that maybe you guys have been through all this clubhouses with me, that I am someone who likes to take the outliers. I am someone who does not enjoy negative skew and finds it extremely risky. But that doesn't mean that the implementation that we do to execute it is less valid. It's just delivering a different aspect, I would say.
Hey guys, glad to be here. I think this comes down to a question asked by Jerry a couple of weeks ago on the podcast, where it's how different it is to find the quote-unquote perfect trend following system and establish a business. These are different problems. But I think coming to Derek's point, it comes to us to understand what our clients needs to understand what product they're looking for. Perhaps
I think
perhaps a 100% trend following classic trend following system is not exactly what they want or what they need. Or perhaps it is and they just don't know, and it comes to us to explain to them why they need it. And then I come to, I think it was Bruno's point, that we should understand how our systems fit in these mostly negative skew strategies work, and how do our own trend following system complement them. Oh, sorry, it was Derek's point, to be a part of the puzzle. It reminds me of Chris Cole from Artemis Capital take on the, I think it was a term he coined, complementary Sharpe, something like that, where we evaluate how much our system adds to the client's portfolio, how much our client's Sharpe is increased when a significant part of their portfolio is with our systems.
I think that most people will say that they don't need trend following. Maybe I'm wrong, but it's really we can be very good in our communication skills and in a very simple way to educate people in a very simple way. Not the full education, of course, because it can be complex, but in a simple way to show them how it works. And if we, like Bruno said, you say very good words, that they must understand that they need it, if they really need it. But a lot of people don't need such type of strategy because they really don't understand, because their psychology works in not in this direction. People they have thinking habit, another type of thinking habit in our life, and we must tell people how it works. So the conclusion that we must tell people how it works, and that people that will find it's useful for them, they will be our clients. I think so.
I think Bruno said something very important that I'm going to take to heart. It is that building the business and the strategy are two separate problems, and he's referring to Jerry. And I think that that's the crux of where us young managers are stuck.
That's why we sin, Derek.
That's right. And having more respect for this idea that, like Eric Crittenden has, where you have a fund that's long, half the value is along the S&P, and the other half is your managed futures program, and just go for it. Just believe. I think he may believe it. I wouldn't believe it honestly that that's an optimal portfolio, but I think it is. Some people do think that, especially, if you look at recent data, the data is going to say, hey, yeah, give me a heavy allocation to long stocks and maybe some bonds as well, and then throw in some managed futures. That's great. But if you look at all the data since, from wherever, 70s or 80s, then nothing is going to improve the classic trend following, maximally diversified currencies, commodities, stocks, bonds, long, short, risk control, letting profits run. Nothing's going to improve that, except if you redefine what improve means, which is, sharp, and things that we don't really like so much. And so we're kind of in this loop. I feel like I'm in a loop here where I can't get out of it, because as soon as I provide a great solution, the definition of my solution is changed, because we're all back to liking sharp, and Jerry doesn't like sharp, so he's really weird.
I wish Niels was still on, because I listened to what Eric says a lot. I value it because we were in the same program at the same time together in undergrad. And I think what he was saying is that's the most optimal for the investor, not for getting the best return over time. But maybe Niels can clarify that in greater detail.
Sorry, I just came back to the call. I didn't hear the first question that you wanted me to clarify. Sorry about
we were talking about the portfolio construction and Eric's 50% long S&P, 50% managed future approach, and its effectiveness, and whether that was, he personally believes that's the most effective portfolio, or whether that's the most effective for the most palatable, I should say, for the investor to get the best trend following return in the marketplace for competing for funds.
Yeah, I think the way I remember his argument is that it's the best way that he's found to get trend following into people's portfolios, right? So, those of us who are on this call, we all know that, well, it doesn't really matter how you get it in. You should just have an allocation to it. It should be a core allocation. The challenge is that we also found as a group, and Eric as a specific firm, that it's just really, really difficult, and it's to a large extent impossible through the advisor network to get them to buy this, because it becomes a single line item that is just too volatile for them to embrace. And so the way he solved the issue was to say, well, let me just blend it with equities. So it's never going to be the best performing, most likely not the best performing, but it's never going to be the worst either. And that's the way where they get it into to the portfolio. So, yeah, I mean, it's kind of a marketing approach, which seems, in my view, pretty good. I actually remember back in the 90s when I worked for Jerry, we had the concept of portable alpha already there. And one of Jerry's programs, I think it was the Financials and Metals program, correct me if I'm wrong here, Jerry, we talked about how we could overlay a portion of that to the S&P. Not sure we ever got around to doing it, but the idea is not new, because it's always been a struggle to get a trend following into a portfolio as a single line item. So I think we just need to continue to be creative in terms of how we can put these products together so that the people get the end result that we think is better for them long term.
Yeah, not having trend following CTAs is a problem. So doing what it takes, whatever it can take to get people to do, maybe they can't do the whole right thing, but they can do partially the right thing. I think another thing that I struggle with is believing that a long allocation, permanent allocation to stocks is a good idea. Something without a trailing stop that would it would be hard for me to accept in my own personal portfolio, although it just seems to work so darn well. And I just feel like to some degree it's like obvious, like whatever it is, it's the S&P today, maybe it'll be something else tomorrow. Just take the greatest performing market and put it with something else. Oh, great. Yeah, of course it's going to, because you've just chosen the best single thing to invest in, and pair it with CTAs or pair it with anything that's probably going to do pretty well, and make the CTA performance look better. So I'm just waiting, that these stocks don't always have the best return, but it's been a very long wait.
I think that in a sense you shared something on Twitter, maybe in the last 24 hours, Jerry, that's kind of relevant for that discussion, and that's an article by Morgan Housel, where he talks about something that looks seductively, or you get seduced into believing that the past will look like the future, right? And I think with equities, that could very well be one of these things where we are expected that things will just continue to look similarly, and maybe the next 20 years will be completely different.
One of the other things I think which makes trend following different from other styles of investing, if I would say, if you look at venture capital, for example, I mean, they rely on the same exact thing, right? They're betting on outliers to make their returns. But people ultimately, at the end of the day, I think also, they buy stories, they don't always go by numbers. And if you talk about equities, you'll identify it with Warren Buffett. If you talk about global macro, you'll say, oh, George Soros, the man who broke the Bank of England. But I think somewhere trend followers don't talk a lot, or don't come out and take credit for. I mean, it takes a lot to follow a system for 30 years, and not many people who've not read Michael Cowell's book will know that who was it on the other side of the trade when Barings Bank went down, and he alludes to the fact that it was John Henry. But those are the kind of things that sometimes helps to make these things more familiar, and make it easier to explain to people what it is that trend followers do.
I mean, I think certainly from my conversation with Mark this weekend, I think it's clear that investors don't just buy performance. There's so many more things that goes into it, and a lot of it is actually qualitative in nature. And I think that's true. That's, I think, what I've experienced as well. That people don't necessarily buy the best performing fund. I've certainly lost out in some pitches to people who didn't perform as well as we did, but they had some other things that people liked about them. What's funny about what you mentioned there about the story that Michael Cowell came out with about who's on the other side, it's John Henry. Well, sure, it's John Henry, but it was also Chesapeake and Don and everyone else. I mean, but it becomes a narrative, it becomes a great story. Oh, now we can say it's John Henry. No. It was all of us. But John Henry at the time was probably more better known or whatever it might be, and so he becomes the narrative. And I don't disagree that narrative is super important, and so on and so forth. But for me, it's not really necessarily those kind of stories that helps. I just think we could find better ways, like some of the things that Richard has brought to our attention, better ways. Maybe as Mark said, maybe we all talk the wrong language, because on the other side of the table we have all these CAIR and CFA people. No disrespect to them, a lot of respect actually to them, but maybe they do speak differently to what Jerry says or what I say, because we don't have those degrees, so to speak. So I can certainly understand that if you speak to someone who speaks the same language as you, and this is why I think storytelling is actually really important. But especially if you can speak a language that people really understand and then that's super important to to get the outcome that you want. And I think you see that in all businesses. If you just look, I was watching the latest launch of Microsoft's new products in the last 24 hours. If you look at their presentation today, don't they look like Apple did 5 years ago, 10 years ago? Sure, because it worked for Apple. That's the way they communicate. So now, even Microsoft is doing exactly the same thing. And this is why narrative, even in the systematic trend following world, if we want to have external clients, we need to understand this part as well, which I think a lot of managers, and some of them I know, of course, they don't think it's that important. I mean, I remember, Bill Dunn, when he started the firm, he had fantastic results, and he truly believed that that's all it took. As long as he put on great results, people would find Dunn. Well, that's not exactly how it works, right? So this is, I think narrative is important.
Hey Niels, we were talking about this topic, actually for the last hour, I think, and it's great. I think it's not simply a narrative. Well, perhaps I'm misunderstanding what you mean by narrative. I think it's not simply the choice of words or the story we're telling. It also comes down to understand what the people on the other side of the negotiation need, and then we must tailor our narrative, choose the correct words, talk about Sharpe and risk parity and vol control and everything, not giving up our golden rules of trend following, but tailoring the speak so that they can understand and see why they need the stuff we offer.
I agree, Bruno. I would go even one step further, because you said it yourself, right? We need to understand the people who are on the other side, and often the people who are on the other side are not. It's not all of the decision makers. It might be one of the decision makers. So the way I think about it is that, and this is why I think when I say stories, I'm not talking about fairy tales. I'm talking about stories that are on narrative that is easy for people to remember, so that they can themselves repeat it in front of the investment committee, because then that's where we are not present, right? We deal with maybe one analyst, maybe two analysts, but then they have to go in front of the investment committee and present. So this is why I think stories are important, or narrative is important, because if you truly understand who's on the other side of the table, and you can craft your message in such a way that they, one, can easily understand it, because if they don't understand it, they can't repeat it, right? So you need to make sure that they fully understand what you're saying. And not everyone, as you rightly say, not everyone understands the same wording or speak, so to speak. But so we need to make sure they understand it, so that they can repeat it in the way we intended it to be said and delivered in front of the investment committee. So that's what I mean by narrative. It's to actually equip the people we talk to well enough so that they can be our champion, so to speak, on their internal side.
And I want to say that, as you Niels said a lot of times, that simplicity doesn't sell. So maybe, and I liked ideas of Mark Zubrzynski. He said that, okay, we can describe it in a not very simple way, I don't remember all his words, but the idea was that it's he said it's VUCA, volatility, uncertainty, ambiguity, and I don't remember what was what was it, but it's I think it's very important to have a concept here that it must be very simple and it must be not must be very complex here. Of course, it must be simple to understand. I said today that we must be simple. I think so. I'm sure in communication, clear in communication. People must understand what we are talking about, but what to do with this? Simplicity doesn't sell. I want to.
Well, so when I say simple, I actually don't mean simple in a negative way. In fact, I think, and I'm sure you will find there's an expression when you see people start a letter, they will say, "If I had more time, I would write you a shorter letter." And what they mean by that is that it really takes time to get the essence of your message down to fewer sentences. Everybody can write long form, but actually get the same points across in a short message is much harder. So that's what I mean. You want to keep it simple, but just like we say with the system designs, that doesn't mean it's easy. In fact, it's probably more difficult for us to explain what we do and all the important bits in a quote unquote simple way, but give them enough for them to fully understand and embrace what we do. So I don't think there's a disconnect as such. I think actually it's really hard work to simplify not just the systems, but certainly simplify the message so that we know it won't be misunderstood, misinterpreted, or misspoken when these analysts sit in front of the investment committee.
So sorry, just a quick question here. Niels, those are some great comments as well. And I guess it's to the wider group as well. Are you finding that folks are not understanding what trend following is, or are they understanding it but not wishing to pursue it further? I mean, just as a point of comparison, just on some personal experience as well, like in the hedge fund world, there's some overly complicated strategies, at least what I would feel are overly complicated strategies, but they don't seem to have the same problem of raising money as, let's say, a more simplistic, and I use that term loosely, trend following strategy would. So what really is the issue?
That is a great question, Boris. And I've often wondered, because when I look at the strategy and I compare it to other things, I'm thinking this is really simple to understand compared to some kind of, credit arbitrage fund or whatever. You think, well, buying high and selling low, that should be fairly straightforward. So I don't know that it's because they don't understand what we do. I think it's partly something where they feel it's very, just like we as managers find it incredibly hard to embrace and stick to and hold on to. I think that's definitely part of it, right? Whether they think that, no, this is too simple, it's impossible that this will actually work going forward. Maybe there's a little bit of that. What's always puzzled me, Boris, is that there's actually never been a white paper written that doesn't confirm that you need to include trend following or the return streams of trend following into your portfolio to get a better performing and a safer portfolio. So it puzzles me, and I think your question is something that we may not fully understand yet. What it is that makes it so hard for people to embrace this. I think sometimes it's easier on the individual side, on the high net worth individual side. I think sometimes they get it quicker. I think sometimes maybe institutional investors just struggle a bit more to accept that this is something they should have. Now, there are a few people who've done it. I think maybe we talked about it on the episode with Mark. I mean, if you look at some of the very large US pension funds like CalSTRS, in their risk mitigation part of their portfolio, they actually have at least 40%, at least when I interviewed them a few years back, but I think it could be even higher now, 40% trend following and then long bonds. That forms the bulk of their war chest against adverse market moves in equities. They call it risk mitigation. So there are some people who've kind of led the way, and I'm sure they've done all kinds of analysis and due diligence on the strategy and so on and so forth, and come to the conclusion that yes, this is something we definitely need. But it doesn't seem to really help most other people adopt it as a strategy. And so that disconnect, I don't personally fully understand yet, but it's something I would love to find out what really holds people back from embracing it.
Yeah, it would be good to do, I guess, a survey on the back of your last podcast there to see and to interview, I guess, or to survey portfolio managers and so forth who don't embrace trend following or who don't have it in their portfolios, who don't recommend it, and to really see the reasons why. I think that data would be great. I mean, I have my own opinions, but I think they're too narrow to kind of paint the entire industry with the same brush. But just as a point of emphasis, I mean, there's quite a few family members or friends that, you know, want to get into trading or investing, and I obviously tell them about trend following. And it's interesting to note that almost every one of them has this kind of shrug to their demeanor when I tell them about trend. Say, okay, you know, because when I simplify it and say, you know, if the market goes higher, in so many simple words, you buy and you trail, you put your stop loss here, when it hits, you're out. It doesn't seem to hold any water with them. It doesn't seem to interest them. It doesn't seem to do anything for them. They'd rather go through, you know, reports and read articles and find the hot stocks and so forth. So I don't know if there's some sort of natural inclination to shy away from simplicity. And we see that in many other different things. But once again, I think that's too narrow and just based on personal experience for me to brush the entire industry with that brush. But it would be good to see if there is a survey that we can kind of tease out some data to see why is it that it's not being widely accepted. Because I think it's a little, I mean, at least for me, it'd be crazy to conclude that, you know, a bunch of CFAs and Kaya members would not understand the concept of trend following.
Yeah, I agree. And I think this could be it could be an interesting exercise if we can find people who are willing to stand up and share that. And this is frankly also why I say on the podcast, I mean, we as a group, we as a tribe, we need to share this stuff because otherwise it's not going to be widely adopted. I'm not saying that we want necessarily everyone to do trend following, but we certainly want more people because they will lose out when the next thing happens in the markets, right? And these strategies are there to help protect them.
So this is all fascinating. I have a lot of thoughts running through my head. You know, one is the S&P is such a bad performer, but it's been consistent. And so the 8% return with the 50+% drawdown, no one would on purpose try to design something so poorly. And yet it's, you know, it's the preferred investment for everyone. It's the go-to. It's the core. I just can't help but think, I mentioned this over the past few weeks, that I did a back test recently when I decided to go longer term trend following, one entry, one exit, and a stop loss. We did our back test in 2000 and it just made money every year. And so recently I mentioned we did another back test with just a random parameter that we use, one of our 4 systems. And it, once again, from 1977, you know, it made money every year. And so now one of those was less than 1%. So if you guys did it, which I encourage you to do, the holding period is like 1 year on the average for a trade, then, you know, you're going to find maybe a few losing years in there. But the point is these systems are so consistent, just like the S&P. The simpler you make it, it's going to have very strong possibility of making money almost every year. But there's no way that a diversified portfolio of currencies, commodities, stocks, and bonds is going to be as poor as the S&P's return and the max drawdown. But what I found interesting is that I don't know of any manager who has that track record, because even on our calls, we're, and because part of the problem with this simple system is it has big drawdowns from peak profit. It's going to hold. It's still long, maybe Bitcoin. That's been a hell of a retracement. It's still long, possibly lumber. It's a hell of a retracement, but still also long Moderna and Tesla and natural gas, both, right? So it seems to me that even we talk about how do we make this better? We got to trade a little. Let's add in some shorter term stuff. How do we minimize some of these drawdowns? And so we're not even on board with a long-term system that's super consistent, but yeah, has these very uncomfortable give backs. And I mean, I'm in the same list. I don't have that track record either. So I just think it's kind of interesting that the core, it doesn't have to be super volatile like Mulvaney. He may be the closest one out there to a pure trend following strategy like that. With no apologies and no risk management other than taking small losses. But I do think it's very interesting. I would love for someone here who is on the call to do their own back test. I'm sure tons of people have this capability, and then try a breakout that basically holds on to trades for about a year and see if you can replicate what we found, which was it makes money almost every year, and that you would think would be good enough, and that's what the S&P has been doing. It's certainly good enough for the majority of the world. So I do think performance is in there, and our purity. I talk more pure than my trading is, and that's been a mistake over the years.
One thing that I'm picking up here, and it's the fact that there obviously is some business to be had out of this strategy, because if you look at the AHLs and even Dan, Niels, and probably you, Jerry, there is a business to be made. But I guess the biggest one of the big problems is that, and you just you just said it, Jerry, the simple asset that it's okay but a bit rubbish, but everybody loves, is already there. It's the S&P. Everybody loves the S&P. Everybody loves the S&P, and that in and of itself is a bit of a trend following strategy, because it buys strength and it sells weakness at every rebalancing day. So by default, you're now forced to do a little bit better. And of course, this strategy can do a lot better. But one of the things that investors, and at least has been my answer, but what investors absolutely want is not just returns, but a bit of peace of mind. And there are all these metrics, and I can think of Jack Schwager's pains to gain ratio and things like that. It seems to be resonating with investors. Yes, you're delivering me these returns, but how are you doing it is also important. It's not just about getting maximizing terminal wealth, because this is all very well and good, but what is terminal wealth? I mean, terminal wealth for me may not be the same thing as for all of you on this call. So it's difficult to pin down. So I think the synthesis and the sort of the point of contact between all these concepts and strategies and languages and vernaculars and narratives becomes when you're trying to sort of find the best trade-off between purity and practicality and pragmatism. Otherwise, I think it's we're sort of yielding to defeatism and thinking that yes, I mean, this is the best strategy, but.
Hey, Jerry, I had a quick question on your back test. I've done a lot of back tests over the past few years, and I've never been able to replicate a track record that doesn't have a down year. But I've never tested with single stocks, and I wonder if that is a big component. If you run that test without a single stock allocation, does it change the results?
It will change the results a bit. In my research, the big benefit to the single stocks is less of a smaller drawdown, but I think that should not. But I wouldn't get hung up on never having a losing year. Like I said, you can manipulate the back test and make certain decisions, and bingo, you have no losing years. And then if I do it, I may have 3 or 4. But the bottom line is it's going to be incredibly consistent, more consistent than the S&P. And which if we want to target 8% or whatever the stock market average is, our drawdown is not going to be 50, probably. It's going to be about twice that, or let's go 3 times that. So now we're at 8% and a 24% drawdown versus an 8% and a 50+% drawdown in the S&P. Or we can try to make more money, 15%, and start approaching that 50% drawdown. So either way you slice it, there's no way that what we do is going to be better. You can't hardly improve upon it, not using robust ideas. And but the S&P has one massive characteristic, and that is it follows its own rules all the time, irrespective of performance. And that is taken out of humans' ability to change that. And I think that every CTA firm, every trend follower, they always have that ability to try to minimize some of the bad periods. And I think most people fall into that temptation and actually do that, or they put in rules, something beyond the one exit rule, the one trailing stop, in order to hopefully mitigate bad periods. But the S&P says, no way, I'm not going to do that. You're going to, because I've got these rules, I'm going to follow them, and some of these funds have $1 trillion in them, follow the S&P, and we wonder why. I think I've been on record as saying I think it's not so much active versus passive. It's discretionary versus rules-based. The S&P has got bad rules, but they're at least rules, and they follow them all the time, and very few people can beat them with the rules staring you in the face. And I think the same could be said about a simpler trend following, especially if you say, hey, develop a very consistent trend following strategy that makes good money and maximizes the winning periods and the winning years without regard to Sharpe. And it should be a piece of cake.
Just going back to the question from before in terms of maybe why we haven't been as successful as we would like to think. I actually think that a lot of it has to do with the fact that we deal with a strategy that looks volatile and uncertain in terms of what the next move is going to be or the next monthly return. And I think we as human beings, if there's one thing we don't like as a general rule to deal with, it's uncertainty. And so, and I think this is why you see a lot of these other strategies that looks safe, that looks stable, where people feel that there is no quote unquote uncertainty that they need to worry about. That those are the ones that attract, most of the assets. So in a large way, I think that it's down to something as quote unquote simple as that. That we are not creatures. I mean, we are creatures of certainty. We don't like change, and also because every time there is change, every time there is uncertainty, that's what makes the headlines, and the media makes people even more scared than they need to be, because it gets blown out of proportion. I think that's a large reason why people don't necessarily want to embrace trend following.
I agree with this totally, because people like to know the future. They feel safe when they think that there is a high probability that they know the future and they're protected by this information. It's false expectations, not something else, and it's our world.
I think it's not just the uncertainty that we face going forward. It's also the feel that when we have simple rules, it sounds reckless to people who don't deeply understand what we do. And this reminds me of one of those excellent texts from Morgan Housel. I think this one is from late August, where he talks exactly this, that when faced with uncertainty, inaction can feel too reckless, but when we are deep in uncertainty, following our rules is the best course of action from our point of view, actually. And I think that's why there's this distance from the regular investor to us, to the way we think and approach the markets.
As I remember, Mark Brzezinski said that in war, military people, they deal in uncertainty and dangerous environment. And all they do, the main thing they do, they follow their rules. And it's very important to understand this moment, and we can apply it to almost all aspects of our life, especially when we are talking about some extreme environment.
And Jerry, I just had a quick question. This is Sean, and obviously you're doing a strategy where you're not afraid to dive into individual equity positions. So with single stock futures having gone away, sort of replicating futures as best you can with LEAPS options, how do you determine how many months out that you're looking at those? Are you typically trying to look at the absolute farthest LEAPS available, or are you sort of having a floor for the open interest on those contracts?
I think Jerry's had to head off, so look,
Oh,
maybe Niels
see,
can
yes.
maybe Niels can answer that,
Yeah,
if you
I
just
don't really,
Tinkerson.
I mean, so this was specifically to single stocks, right, Sean? And so, is that correct, Sean?
Well, it would be single stocks, or
Yeah.
I mean, even ETFs, if there's any,
Right.
sort of pinpointing that we're doing with anything where you're using LEAPS options in part of the strategy.
Yeah, I just have never traded it, so I'm not the right person to ask. Best thing to do, Sean, is to either wait a week or send it in as a question next time Jerry's on. I'll bring it up with him.
All right, thank you.
So now you're in the hot seat, Richard. Take it away.
Well, look, I don't know if people want to continue on, or we could call it a day. It's up to everyone. But yeah, look, thanks very much for all attending. I might head off. We've got about an hour and 17 on this recording, so I have recorded it, and I'll get it out to Jerry so he can distribute it. But thanks very much, everyone.
Take care, everyone. See you soon.
Thanks,
Thank you,
everybody.
gentlemen.
Thank you very much. I was very happy to be here.
Thanks,
Cheers,
everyone.
Oleg.
Bye-bye.